The geopolitical premium that we're seeing in oil markets right now, I'd argue it's pretty small, just a couple bucks here. Should it be higher? What do you think?
Yeah, we agree. We think it's small right now, probably $2 to $3 per barrel. And, it's probably about right, but if there is a lean on it, maybe it should be a little bit higher.
Why isn't the market pricing in a higher risk here?
It's because of the experience of recent events in the world where there's always a risk that barrels will be lost and then they don't actually go away. And the market, I think, has now gotten used to this idea that the world can have trouble and hot spots, even wars, and you may still not lose barrels of oil, right? So we think the premium that's built in right now has very little risk of supply loss, but it's more frictional costs, right? Higher shipping rates, higher fuel costs to move things around.
If we take a look at the oil price since November, essentially, it's been moving, it's been trading in a very narrow range between $70 to $90. What could potentially take it out of that range?
Yeah, we think it's not so much related to the Mideast situation. That would be the easy one, right? If it flared up into an actual war between countries, then that's the obvious way you get there. But outside of that, which we don't think is very likely, it's really the more classic blocking and tackling in the oil market, loss of supply in different parts of the world. We've had a lot of supply disruptions. That's one of the reasons why oil is tight right now in the physical market. You've just had outages, whether it's storm related or, Libya was out for a while, and North Sea. Some of it is seasonal, some of it is beyond seasonal. So it's just the regular things that happen on supply disruption. The other thing is, for the first time in quite a while for us, we actually have a slightly positive skew on demand. Demand for us has been, we've had a base case and then it's usually kind of negative around the base case. Now we've had a slight positive lean.
Because of China? Because of the U.S.? Because last year everyone thought China was coming back big time. It didn't. Could this be the year when that tips the balance when it comes to demand?
Yeah, it's a great point. Last year, the expectations for China were just massive. It did okay, but it didn't meet expectations of the market, and the bulls thought China was going to be amazing. This year, we think it'll be more broad spread, like a global, like a fairly evenly distributed increase in demand. Just as a comparison, last year, China grew by 1.3 million barrels a day on demand. This year, it's not quite half that.
Right.
So they've slowed a lot. So we actually need other parts of the world to have pretty good demand growth, and I think there's a chance for that.